75 years ago, as war raged in Europe and Japan, delegates from all over the world gathered in Bretton Woods, New Hampshire, to build a new global financial system. Through their creativity and collaboration, billions were lifted out of poverty all over the world, and the American middle class was created. But nearly a century later, it's time to recognize that the global economy has changed. We need a new system, one that builds on what worked, free markets and free people, and changes what doesn't. We need a new path for the future of capitalism, so countries can heal fractures within their own economies. From excessive inequality to job loss from technology, we need to win the race for the future of money. The rise of digital currencies, the long-term health of the euro and the dollar. We need to harness all the tools of economic statecraft, from using sanctions and trade policy wisely to reining in financial crime. Most of all, we need to remember what they knew in 1945. Economics, finance, and foreign policy are all part of the same story. This is a time to restore and rebuild America's collaborative economic leadership. This is a time for geoeconomics.
Hello, good morning in the United States, good afternoon in Europe, and good evening in China. My name is Julia Friedlander. I am the C. Boyden Gray Senior Fellow and Deputy Director of the Atlantic Council's Geoeconomics Center, and today we are co-hosting with the Paulson Institute's Macro Polo for an overview and look of the US-China economic relationship going into 2021. And it is our distinct pleasure to introduce a star-studded panel today, beginning with David Malpass, President of the World Bank and former Undersecretary of International Affairs at the US Treasury Department, Tom Orlik, Chief Economist at Bloomberg, and the author this year of an excellent book, China, the Bubble That Never Pops. We're also welcoming Dr. Zhu Min, Chairman of the National Institute of Financial Research at Fudan University and former Deputy Managing Director of the International Monetary Fund. Today's moderator is Eunice Yoon, CNBC's Bureau Chief and Chief Correspondent in Beijing. The first up today, I'd like to turn the floor over to my colleague, David Ma, who is the chairman of Macro Polo, to give us an overview of his excellent report, Forecast 2025, China Adjusts Course. So, Damien, you're up.
Thank you, Julia, and thank you to the Atlantic Council. We are delighted to be co-hosting and also honored to be with such a distinguished panel of speakers today. Since this is an event on U.S.-China economic relationship, I thought I would open with some brief remarks on how we see the Chinese economy going forward. Forecasting is a fraught exercise, especially in this environment. And as the great Yogi Berra once said, predictions are hard, especially about the future. So we have to set some parameters and assumptions, but this is, take this as one view. And I think we're going to be talking a lot more about some of these issues with the panelists. So I want to get to that very quickly. So our main basic view is that over the next 5 years through 2025 is that China is most likely going to elude the so-called middle income trap that economists say. And that's roughly going to bring about nearly half the Chinese population into what might be considered middle income as defined by the Chinese government, about 650 million people. And that's, of course, actually quite challenging. That requires, I won't say reform, because that word seems to have a lot of different interpretations these days. I'll say that requires some significant changes to the current Chinese economy. There are many things I can talk about, but the three key things that will need to be changed to actually achieve sort of a near majority middle income or middle class country is that it's going to be policy has to focus much more on income redistribution, equalizing growth across regionally. It's going to have to draw down precautionary savings, and it's going to have to deal with some aspects of property reform and property ownership, especially in terms of rural property. So we do think that by equalizing growth, by lessening some of the existing constraints, that will have a powerful impact on the Chinese economy over the next 5 years. And it's been one of the key things we saw that's been I guess, somewhat optimistic coming out of the 14th five-year plan, which, by the way, was released on the day of the U.S. election, which guaranteed that nobody paid attention to it. But it seems to be that there's been a dramatic de-emphasis on the growth target, which to us, to me, has been a significant signal that China is trying to shift much more meaningfully over the next 5 years. Instead, they're going to be targeting a so-called quality of life, which one interpretation is that they're going to focus much more on much less subsidies for sort of the current investment-driven growth model, and much more on subsidizing social welfare, things that would draw down precautionary savings policies, incentives that would bolster income, which are absolutely needed if China were actually to achieve what it needs to do over the next 5 years, which is become much more consumption oriented. Now, these are also contingent on China keeping a lid on financial risk and local debt, which is one source of a major risk in the Chinese economy. But the Chinese government is certainly cognizant of that, and we do see them continuing to be fairly fiscally and financially prudent over the next few years. And looking at the 14th five-year plan, now some of these issues have been around for quite some time, and they've been talked about for quite some time, so they're not necessarily new. So when you see the 14th five-year plan, we do get the sense that China is more likely to kind of walk the walk on some of these key issues over the next 5 years. And in part is because I think when you look out to 2035, which is their other vision about realizing basically becoming a high-income country by then, they're facing in this interim period, they're facing some major tailwinds like a demographic transition. And also, I think we all know that the external pressure on China has been higher than it's been in many decades. So I think they're looking at some not necessarily great trends going forward. That's really going to impact the Chinese economy. And so in many ways, they have to start executing on some of these changes over the next 5 years. And so to conclude, is that if they do these things, and it seems like they're more willing to do so over the next 5 years, you're going to be looking at probably a near majority middle income Chinese economy in 2025. And with that, I will turn it over to Eunice to continue the discussion.
Thanks so much, Jamie. And you are a daring man with all of your forecasts. But I wanted to pick up on one of the main points that you brought up, which is essentially that it looks as though China is almost being propelled to push ahead with these economic reforms that a lot of people have been talking about for years. And David, I just wanted to get your thoughts first, right off the bat. What do you think the top priority should be for China for its economic development?
Well, there are a lot of challenges. As far as the domestic economic development, I was interested in the comments we just heard from Damien as far as the the shift toward higher incomes for people in China. So balancing more the heavy investment that's been going into the export industries, shifting that balance so that much more of the investment can go to the domestic economy. I think that's implicit in the 5-year plan, and so we'll see how they are able to proceed with that. A key part of that is how do you allow capital to flow within your economy to new industries or to new ideas, and how do you allow it to shift away from the old industries? And there are many examples. One would be the reliance on coal for producing electricity. How do you allow that shift to occur toward cleaner sources of energy? That's one. How do you shift away from exports that had subsidies in some nature, implicit subsidies or explicit subsidies for exports, and how do you allow that to wind down as you allow more flow of capital, and also, very importantly, the flow of people within the Chinese economy? So let me stop there, but that's on the domestic side. I have thoughts on other areas as well.
Well, I was interested on the non-domestic side. Just as Damien had mentioned, there are a lot of external pressures as well that China is going to be facing.
So that gets to the core of what Damien was saying about if it becomes many people that are that are middle income in the global nature, then China is clearly evolving from being a developing country to being a more advanced economy. That has implications for how China interacts with the rest of the world. And there are many examples of that gets into the issues in the WTO, the issues in OECD, of the Paris Club. All of the relationships should shift, and China should be proud of that, because it has emerged from poverty. The poverty reduction has been a hugely successful trend over the years, and now moving toward more movement of people, movement of skills, and movement of capital. That means that China needs to also then have a different relationship with the rest of the world. Within the World Bank, we're evolving the relationship, and it's going pretty well, but it's substantial. So China, over the years, has gone from being a heavy borrower from the World Bank. It continues to be a borrower, but it's now also a donor and a major shareholder, the third largest in the World Bank. And so that relationship has evolved also in terms of the type of lending that we do inside China. It's gone very heavily, almost totally toward global public goods. For example, a new program on reducing marine plastic pollution in China, which goes into the rivers. If that can be overcome, that helps China build industries, but it also helps the oceans of the world have less microplastic in them. And so this is I hope China sees the relationship with the World Bank as being constructive, and also will view the relationship with the world as necessary, because it reflects the changes going on in China.
Well, as you were mentioning, the Chinese relationship has been evolving for many different countries. Of course, the one that is top of mind for this panel is with the United States. And so, Min, I want to get your thoughts on that. And there are so many people who would say that the relationship right now between the U.S. and China is at a low. What do you think the avenues are to be able to repair the relationship right now between the U.S. and China? Dr. Zhu Min?
Yeah.
Yeah.
First of all, thanks for the invitation. It's a great honor for me to join this session. And for particularly China and the U.S. economic relationships, the first issues, I think I would like to change the title for this session, which called the economic competition. I think the real title should be the economic collaboration, right? I think that's the key issue. I think there's an urgency for both sides to work together. We're in a crisis, right? The global GDP, the growth will dip 4.4% by IMF, right? And the trade will drop 8%. And plus, most of the country use up the policy space, and the second wave of pandemics is coming. And we are in the second phase of a crisis, which is a sovereign crisis now. The liquidity crisis is gone. So we are facing so many challenges. I think that's really, there's urgency for both sides to work together. How can we work together? The first issues I really think we should put economic issues back to the table on the top of the agenda, as I mentioned, because the urgency, I think that's the key issue. And there are so many things. Trade between two countries is the issue. Trade runs very well, I have to say. In the past 11 months, trade growth roughly 5.8%, given the 8% drop for the whole world, which is amazing, right? Which reflects the interconnectivity between two economies. Both sides really, are closely linked to each other. But the clarities and also the policy, the fundamental, the framework for the trade today, for the trade in the future, I think this is also very important. Capital movements is also another very important issue. A lot of capital move freely. I think it's good for both US and for China, improve the efficiency of the market resource allocation, and also for the whole world. And I saw American capital want to move into Chinese market because this is quite a big and a booming market. And Chinese people want to have their wealth, have a global location, right? So let capital move freely, which is also important. Clear the boundary for tech sector and IP protections, tech transfers, I think is also very important here. So use a sanction as a random approach, create a lot of uncertainties between the two economies and for the whole world. So I think clear the base and the framework for the tech sector is also important. Overall, put the econ issues, go back to the top and start to talk. I think the dialogue is the most important thing. I recall in the Obama administration, so we have more than 100 dialogues. Then when the new administration, Trump administration moved in, so he cut 100 to 4 and 4 to 1, which trade, and 1 to 0 now. I think the dialogue is the most important thing. The first issue is let's start to talk. I will stop here. Thank you.
Well, Tom, what do you think? I mean, there's so much frustration right now in Washington about the relationship with China. I mean, I'm assuming that there's a lot of frustration. I could feel it all the way over here in Beijing. Do you think that the Washington establishment is ready really to be able to start that conversation with Beijing, get things back on track so that the two countries could eventually target what Min had talked about, I mean, trade, tech, movement of capital? What do you think?
So I certainly hope so. As Damien and David and Min all said in different ways, I mean, there is a huge amount to get done, both in terms of the US domestic economy, the Chinese domestic economy, and the state of the global economy, where clearly the capacity of the US and China to work together is going to be a critical feature. As we await the incoming Biden administration, there is obviously a chance for a reset in US-China relations. My view is that sort of a key stumbling block to that reset is a lack of realism in the Western view of the Chinese economy. I think too often we approach China's economy with the assumption that China is a weak and inefficient economy, an economy which is weighed down by debt and burdened with a massive, inefficient state sector. And we don't pay enough attention to the sources of strength and dynamism which have driven China's growth for the last 4 decades, and I think will continue to drive it in the years ahead. The trade war and the COVID pandemic have provided a kind of a stress test for the Chinese economy. And if the kind of the Western view that China's economy is weak, inefficient, debt burdened was correct, then faced with first tariffs and sanctions and then the COVID pandemic, we would presumably have expected China to collapse. And clearly that's not what's happened. China continues to expand its share of global trade. China continues to climb up the global technology ladder. China's economy, we think, will be the only major economy to have a V-shaped recovery from the COVID shock. We expect 8% growth next year. And so I think the approach to China, which we see too often from governments in the West, which is grounded in an assumption of weakness and inefficiency and a broken model which needs extensive reform, I don't think is correct. And I don't think it resonates in Beijing. I think it's a stumbling block to having a constructive, cooperative relationship. I think there are some specific areas where, to borrow a phrase which we often hear in Beijing, there's scope for a win-win solution. Min and David both in different ways mentioned capital markets. That's an area where the People's Bank of China sees an urgent need for reform to increase the efficiency of capital allocation and start managing down China's huge debt burden. And that's an area where the US has a huge amount of expertise, and US firms, as you know well from your role as a sort of key financial anchor of the press in Beijing, Eunice, know, where US firms have a hunger to get into the Chinese market. So I think capital market opening, capital market reform is an area where there's potential for a win-win. On the bigger asks from the United States, things like reform the state sector of your economy, I don't think there's a meeting of minds between Beijing and Washington, D.C. And I don't think Washington, D.C. has the leverage to force reforms in China if Beijing doesn't already think that those reforms are a good idea.
So one just quick logistical note for the audience. If you have any questions, please do submit your questions to the Q&A function so that I could not answer them, I could ask them so that other people, the panelists, will be able to answer them. But so Tom, it was interesting you were saying that there isn't this meeting of minds. What would you suggest then from the Western perspective? Like what would be more practical so that the US and China would be able to get together and really understand each other better?
So I think if we go back in time to the period before the great financial crisis, I think there was genuinely an important constituency in China which wanted to move the Chinese economy much closer to the Western economic model. Let's have something which looks like an open capitalist system. Let's significantly reduce state ownership in the economy. Let's quickly reduce the barriers to cross-border capital flows. I think following the great financial crisis and then following the COVID pandemic, where China appears to be putting in a very strong recovery, I don't think there are many people amongst Chinese leadership who still have that view, right? I don't think there are many people in Beijing saying we need an economy which is more like the American economy. And I think what that means is that the scope for kind of very broad ranging reform agendas, with the US providing a kind of not just encouragement, but also a model which China aspires to and can work towards, just isn't there anymore. And what that means is that the scope for economic cooperation needs to focus, as David suggested, on some specific areas like free movement of people, free movement of capital within China, where there is an urgent need for reform, which is recognized by both Beijing and Washington, D.C. And as Min mentioned, on urgent areas of international cooperation, right? We are, after all, in the biggest global recession since at least the 1930s. This is a moment, if there was ever a moment, where the US, China, Japan, Europe can and should be coming together and agree short-term policies to lift the global economy out of its slump.
So I have a question here for David. David, you have been a key player in the G20, agreeing to grant debt relief. And for the first time, China was part of this agreement. Do you think China has done enough on debt relief? And what would you like to see in terms of debt relief from both public and private creditors in 2021?
So the G20, as you know, during 2020, I had a communique that set up a common framework that was aimed at providing some forms of debt relief, but it had pretty limited boundaries as far as what it was going to accomplish. The problem, and I think people should agree on it, is that many of the poorest countries, in fact, there are 75 IDA countries, very poor countries, who have accumulated a lot of debt. And so there needs to be a process to reduce that debt one by one as the countries run into obstacles. So China has done some of that, but not enough. They've committed fully to the G20 process, but that that needs to be defined in terms of what is debt sustainability, what are the metrics for countries to actually get enough debt relief that they can become attractive to new investment. If you think of who the audience for debt relief is, it should be small businesses in the country themselves. Would they put their family's money into a business given the knowledge that the government has already contracted huge amounts of debt, often in non-transparent ways with outside external creditors? So the core things that are still needed are full transparency of the contracts with the governments of the poorest countries. That hasn't been achieved. And then very importantly, the interest rate levels that are being charged. Many of the Chinese creditors are still charging very high interest rates, and then they show it on their balance sheet in China as if it's a payable, as if it's an asset at that high interest rate. And so I think both, as we think about China's capital structure, it needs to allow capital to move, but it also needs to recognize that that there are going to be, because global interest rates have fallen a lot, and many of the countries at the bottom are not able to pay those interest rates, there needs to be a process to reflect a much lower interest rate in the contracts, and then also in the balance sheets of the institutions. And I don't think we're at that point, though I think I want to come back to my opening comments that it's in China's interest. One of the evolutions I think that needs to go on is for China itself to recognize that it can interact with the rest of the world in a very positive way, a constructive way, but that will take changes in how it works. In the growth recovery or the V-shaped recovery that others were talking about that's going on in China, that's been heavily fueled by export growth, meaning China is getting providing the supply, and the rest of the world is providing the demand. And so that imbalance in the global relationship, I think China could constructively make progress on by encouraging more demand in China. That means the labor mobility that we talked about, the capital mobility, allowing a bigger social safety net. It's very important that China find a way to support people that are left behind. For example, the immigrant workers inside China need to have measures that support them and allow their demand to grow as China makes economic advances.
And I think we are already seeing that with what appears to be more of an inward turn almost with China and its economy. Some would say it's going too far. Other people would say that it's actually a good thing. But
well, you saw the export numbers just out this week. They were heavily, and I think Professor Professor Zhu, said, pointed that out, that a big percentage of China's current growth is coming from the external sector. So that transition, I think, still has substantial more room to go.
And Min, I wanted to get your reaction to David's discussion about debt relief. What do you think China would be willing to do in order to grant more debt relief? What's sustainable?
I think the first issue is we have to recognize China is still a low-income country with per capita GDP around $10,000. But China provide quite a lot of development finance to the low-income country and emerging market, which is a real contribution to the global development and for the shared prosperity. Use our terms. I think we have to recognize. I think this is the first starting point, right? The second issue is Mr. Malpass mentioned the Chinese credit charge a little bit of high interest rates because China used to call this a development financing. So it's not an ODA. It's not also sort of a pure commercial lending. It's sort of blended ODAs and the commercial lending, and try to balance between the assistance and also the commercial incentive as well. So I think that's the way for that. And China also joined the DSSR and the Common Framework for G20, and also go a little further now. When in April, G20 extended their suspensions to the April next year, China quickly extend to the end of next year, another 6-7 months now. I think this is also China's contribution for the whole thing. I think the key issue is from our view is we want to balance between the debt suspension and debt release, and with the future incentive for the credit continue to provide the capital to the country and the companies who need the money, right? So we have to balance so these two things each other. I think that's the most important thing. And I think international community need to talk those issues and in very broad sense. And to go back to Mr. Malpass just mentioned the domestic market. China indeed, I mean, particularly in the next 14 to 5 years, as you are full aware in Beijing, right, pay more attention on export and deepening and cultivating the domestic market and transform China gradually into a more domestic consumption-driven growth economy rather than heavy investments and export-driven economy, which is on the way.
So I have another question from the audience. This is for all the panelists. Nearly all of you touched upon the importance for the US and China to work together, highlighting the financial market. How do you expect the dynamic to change on that front under the Biden administration, given that the Trump administration has been consistently introducing more restrictions for Chinese firms to access US capital markets through the delisting bill and blacklist of firms by the DoD?
Well, if you ask me, I'm not American, so I have no idea what the president-elected, Joe Biden will have on his list. But let me say a few things, my wish list, I think, from this end. On the few things, let capital move freely. I think it's very important. For example, US pension funds want to invest in China for the long term because looking for the high return also. And as I said, and China and want to locate financial resource globally. And also previous Tom just mentions, and China have a huge financial resource, the US have a huge financial expertise. And this is really both sides, if we can work together, is good for both sides. China's forward is to do further financial sector reform. We start a really deep, grand financial reform in 2018. We opened the door broadly, and today, JP, Citi, Goldman, and Bridgewater, you name it, S&P rating, PayPal, all in China now. But more, I think the market is huge, and so China will welcome more American financial institutions moving to China with more than 51% ownership or even 100% ownership of doing the business, enjoy the local environment and equal to the Chinese company as well. There's a huge room to work together. So in financial sector, I do see a lot of room both sides can work.
Tom, David, did you want to take it?
I can say a few words. So look, I think there are clearly some areas of intense cooperation, intense competition, and rivalry between China and the United States. I think a sort of a basic principle of competition is that if you want to win, you should take steps which have big advantages for you and big disadvantages for the person you're competing with. So on the financial sector, I don't think it's actually very problematic for China if the US blocks investment flows into China. China has a massive surplus of savings. If anything, the sheer volume of savings that China has is a problem for China's economy. So whether or not US pension funds move money into the Chinese economy is not really a problem for Beijing. What would be a problem, I think, for both sides is if the opportunity for the US financial sector with all of its deep expertise to operate in China with its deep need for more efficient credit allocation is missed. I feel like that's a kind of an obvious win-win opportunity, boosts US exports to China, allows China to deal with its deleveraging challenge in a more efficient way. So I think there's an opportunity in the next 4 years to see a reset in China-US relations. I think capital market opening, where China has continued to make progress in the last 4 years, making it easier for foreign investors to move into the bond and equity markets, making it easier for foreign ownership of equity brokerages and other financial firms, is going to be one of those opportunities where progress can be made.
Eunice, I didn't jump in because I didn't mention capital markets as one of the key steps. You know, that was a very big issue in the 1990s and the beginnings of the 2000s. Where the world stands now, China is interacting in many other ways with rest of world in organizations and so I think some of the challenges there will take the forefront. With regard to the capital markets, I think the transparency gap is an important one, where China operates under different standards than rest of world, and so that will be important, and also the future of Hong Kong within that, because it was such a core part of financial markets. We saw recently the Ant Financial transaction pulled from the IPO list, and so I guess my thought would be that the transparency issues and progress on those are very important. I do note in the G20 communique there was once again the language that currency stability is important, and so the G20 members are agreeing that with regard to exchange rates, there's this core principle that stability is good for growth and investment. So there's a mutual gain from the stability, and that it has been repeated in each of the communiques since late 2017, and so that I think is a starting point for that purely financial or capital market relationship. And I wanted one opportunity I think for China is with regard to the debt of the poorest countries, to have more transparency in that, and also really move on this separation of commercial transactions from ODA, from development assistance transactions, and have more clarity on that. Right now, there's not a definition of which ones of China's entities are banks and which ones are policy banks, meaning development. And that challenge has been with China ever since the JITC and the IDIC crisis, which I think was in 92, 93, 94. Remember, there was the question of how do you separate policy-based lending from commercial lending within those huge Chinese institutions, and that challenge of transparency and of what interest rate is being charged, how do you do a debt restructuring, these are, I think, very important steps for China that then would help with with capital market development itself.
Well, let me get your thoughts on the development.
If I may, Eunice.
Yes, please go ahead.
Yeah. I mean, on those issues, as I said, China have a development financing concept, right? It was a study. I mean, I think, although traditionally, as Mr. Malpass mentions, ODA and the commercial lending is separated, but given China is a developing country, use of special instruments to do that, have a new concept. I think the whole world really need theorists looking into it to see, whether it's a fit in and the future global development for more low-income countries, and also for more low-income country emerging market join the credit families to provide the credit to the more poor countries. So I think rather it's not simply just say we adapt the old regime. I think that's number one. Number two, the policy financial institutes and non-policy in China is very clear. Export Bank is a policy financial institute, so it's a government public. But State and Development Bank is not a policy, it's a commercial, because I recall even in my life, we did reform on purpose. They convert its institutes from a policy bank into a commercial bank. So the status for development bank is very clear here. But internationally, I understand that they also have a very different views on as a state and development bank. I guess maybe the name is very confusing because of state and development bank. But indeed, in China, it's a commercial bank.
I have another question from the audience. They ask, with regard to developmental and humanitarian assistance, China has maintained a slightly different approach to their contributions in comparison to traditional donors. For example, the majority of the contributions have been through bilateral methods as opposed to multilateral, despite criticism from the West. Why do you think China prefers this method? And with their more recent increase in multilateral engagement, do you believe this signifies their shift towards their norm, or do you believe they will maintain their course?
For me?
Mm-hmm.
Okay, yeah, China do more on the bilateral base, but also do more on the multinational base as well. And so we do both. But in some way, the bilateral things are really more effective and much more easier for the two parties to sit down to talk the needs. And obviously, with multinational platforms, there's more expertise, more platform. But let multinational institutes understand the local situation close to the local need. There's still a gap. I recall I was a member of eminent group for future financial architecture assigned by G20. One recommendation we made is we hope the multinational development institutes will have a platform in the local country, so close to the local country, understand the local situations. I think the Chinese approach bilateral is more in the sense, try to understand the country's need, local situation, in some way which can be more effective. But also China explore the multinational approach as well. So currently, I think it's choosing moving together. I think they both have mirrors and may have a difference. Once again, I think it's worth a further explore, study, but I think everyone, when sitting at the table, should be very open-minded.
David, I have another question for you. Seeing that small businesses provide many jobs, which helps with social stability, how might both countries support smaller players in a time when we see big players dominating, particularly in the US, where the COVID crisis has whipped out many small businesses and seems to be having a more urgent economic crisis? David, that question is for you.
Yeah, that's of course a major issue in development worldwide. How do you remember the challenges Europe faced in 2013, 14, 15, where there simply wasn't capital flowing to small businesses, and so the ECB set up special windows in order to try to encourage that, and it wasn't very successful. You can measure that sometimes by looking at the amount of credit going to small businesses. So this predates the COVID crisis, but I think the challenge is even bigger, as the questioner pointed out. In the current fiscal stimulus and monetary stimulus, it's tending to go to the big companies and people who already have a lot of capital. That's the way the stimulus is set up, and so that and that's consistent with the inequality challenge that we observe worldwide. I think the solution is, many parts of allowing a private sector to grow and to have rules that operate for them. For example, in many developing countries, it takes too long to go through the court system, and so that puts a very big burden on small businesses. So one of the things we work on is to try to speed up the judicial process in order to allow contracts to be adjudicated quickly and in a balanced way. China has immense challenges in that regard that would help, and so I'm noting the importance of rule of law, the importance of transparency, the importance of not having the large state banks dominate the lending process. And I think progress is being made in many parts of the world, not nearly enough. One thing that helps is digitalization, and also the idea of lending activity going through smaller processes, whether you call them processes or digital processes, that actually allows capital to flow to new businesses, and then they can buy the inventory that they need in order to grow. IFC, the part of the World Bank that focuses on private sector, we've made a lot of progress since April in doing two things that are really helpful for small businesses. One is trade finance, and one is working capital finance. So one of the things we did, and I pushed in April and May, was to take the existing client base of IFC, which was severely strained by the COVID crash, and allow them to borrow based on their historical record with IFC. So we could go to existing small companies and make them a working capital loan, meaning a shorter term loan that would allow them to carry inventory, for example, or accounts receivable. And those have been successful in the transition, or in looking toward the recovery. And so in China, I think one of the challenges is the dominance of state-owned industries, and for China to allow the growth of new businesses that are on the side, that are outside the one-party system. That, I think, is going to be a big challenge. It's hard to do. It is in the 5-year plan. You know, there's concepts of this in the 5-year plan. So one of the things is, how do they implement the things that I think China has taken note of this, that in order to grow as fast as the West and to have the per capita incomes really begin to narrow the gap, there's going to need to be adjustments in China's system that allow more flexibility. And so that's somewhere in the 5-year plan, but then it remains to be seen how they actually implement that.
Thank you. Tom, a question for you. Tom is talking about the West's view of China. Is there a unified Western view? Isn't the view different between the US and Europe, as well as Japan?
Yeah, I think that's a great question. I think a certain level of generality, there are some important Western China differences, right? There are democratic versus single party political systems. There are economies which operate on a free market principle, and a Chinese economy which has a very high degree of state ownership. At least between the UK and the US and China, there are financial markets which operate significantly through equities and bonds, versus the Chinese system, which is still very heavily bank-based. So I think clearly there are some very important sort of high-level similarities, and we can talk about, you know, a European-US model versus a Chinese model. At the same time, as the question suggests, Eunice, there's clearly a lot more granularity there as well. Now, for the United States, a lot of the discussion around China economics is framed around playing by the rules, right? Having a level playing field, and so on. And these things are important. But I think a very important additional consideration for the United States, if we're being honest, is the fact that China is rapidly catching up with them, and in the next 2 decades will quite likely overtake and be the world's biggest economy. Now, let's imagine that China is a market-based economy with a level playing field for foreign firms. Would it be okay? Would people in the United States think it's okay that China overtakes and becomes the biggest economy in the world if they're playing fair, if they're playing by the rules? Or would there still be a kind of a visceral sort of geopolitical fear about giving up that #1 position to an unfamiliar and far away country? I suspect there would be. And I think that colors the US-China relationship, and to an extent the China-Japan relationship because of their competitive relationship in Asia, in a way which is different to the way in which countries in Europe, for example, which, sadly from my perspective as someone from the United Kingdom, gave up our position of global preeminence more than a century ago.
Eunice,
Yeah,
can
go
I
ahead.
come in? Tom earlier did present a kind of a Western view of China being weak, and that would be the basis for how to think about to put pressure on China and so on. I don't subscribe to that, and so I think we should be looking for ways to have constructive development of the relationships. And a lot of the burden from that, so sure, the West needs to update and be aware of the realities of China, and that would be good. But on the China side, I think I really want to come back to my point that as China has changed so rapidly in terms of the per capita income going up, the many parts of China would be characterized as advanced economy, living standards, wages, and technology use and things like that, then China's evolution is going to be a really important part of this equation. China intersects with the rest of the world on many fronts, in the law, in organizations like the World Bank, in the Paris Club, in developing countries. And so trying to find ways for those interactions to be successful, I think is going to be a big challenge. And it's going at a fast pace because, if we think about what's changing in the world, China is changing rapidly in terms of the growth of its economy, and therefore we should look also to China for a big part of what the changing perceptions can be. How does China want to interact with all of those legal structures and those transparency ideas and Western rule of law? How does it want to interact with that over the next 5, 10, 20 years?
Min, I want to get your thoughts on that. How do you think Beijing would be willing to make some of those compromises?
Yeah, the first issue is I want to go back to Tom's the point in his opening remark. He said, before 2008 in China, people very much close to so-called Western model and American market system. But I think there's a long-term capture. The crisis is a wake-up call, and as Tom said, 2008 financial crisis was a shock, and once again, 2020 in the COVID-19 crisis was another shock, right? So, and people now tend to think, yes, there's a model, we live in the Washington consensus for long, right? But as a developing country in the new world, they may have a different approach, right? Why not? Maybe it's worth a try, as long as fit in the local need, local practice, local environment, right? And China do have its culture and its system as well. So I think in that sense, we all need to be open-minded. I mean, from China's side, China said many, many times, endorse and support the global economic governance structures and build up since World War II, right? And will merge to the world. But the whole world also will look at China and say, hey, is there any new experience, new principle, new source, and what also can absorb and learn from that? I think then we can create a common future. I think that's a very important issue.
All right, I think that's a great place to end, where we are all going to hopefully have an open mind as the U.S. and China continue to move forward. Of course, if you want to understand more about financial crises, especially in China, you could always read Tom's book, which is The Bubble That Never Pops. Tom, I had to get in the plug for you. But I'm going to now pass it over to Julia.
Thank you, Eunice. Thank you for the excellent stewardship of this panel. Really, our heartfelt thanks to President Malpass, Dr. Zhu Min, and Tom Orlik for joining us today. This is a very crucial topic, and you've helped us tackle some of the core economic issues that we need to really consider going into 2021 and to the Biden administration. I'd like to take a couple minutes or a couple seconds, that is, to acknowledge some of our board members. First of all, are the chairman of our board, John Rogers, executive vice chairs, Steve Hadley and Adrian Arsht, and board members Kostas Pantazopoulos, General David Petraeus, and David Aufhauser. Thank you for being with us today. It's an honor to have you. I wish everyone here a wonderful day and a wonderful evening. Thanks very much.